Hello, Assalamu alaikum to all of you, and a very good evening from my side. My name is Hamad Sarwar, and today we are going to start the second day of practice to pass session of ACCA paper FR. So, if you can hear my voice, please write yes in the chat box so that we can start the session. Please write yes in the chat box if you can hear my voice clearly. Please write yes in the chat box. Okay, wonderful. Okay, I have given you an assignment in the yesterday session in which all of you are required to attempt some MCQs of IS2, IS16, IS20, and IS38. And in fact, I have shared the answers as well on the WhatsApp group. So there are a lot of students who are continuously asking me about how to pass this paper, especially the students who got flunked in the previous attempts. So I will share a special plan for all those students who got flunked in the previous attempt, and even the students who are going to attempt this paper for the first time can follow that plan as well. And there is a WhatsApp group link available shared by the ACCA team and my personal contact number. If still there are students who didn't join the WhatsApp group, you can just contact me on my number, or you just click on the link shown in the chat box, and then you can join the group. So we have covered 3 accounting standards in the last session. That is IS16, then we have covered IS2, then IS20, and IS38. So for the quick revision, I'm giving you a question for IS38. MCO company. So I want all of you guys to just attempt this question. Please just look at this question and reply your answers on the chat box. Very right. One of the students with the name Bisma has already done this question. In fact, these questions are the assignments that I gave to you guys, all of you, in the last session. Yes, the right answer is A for this question. The right answer is A. So if you have any confusion about this, you can ask immediately. Yes, the right answer is A for this question. Is it clear to all of you? Did any one of you wanted to ask anything about this question? No? Okay, fine. Now, what about this one? I've already shared the answer here, C. But I want all of you to please do attempt this question and come up with the that is C. So these are the questions which is related to IS 38, intangible assets. Very good. The right answer for this question is C. Wonderful. If you follow all the instructions and all my guidelines, then it will be very beneficial for you, and it will be very helpful for you, all of you guys, in the examination. But if I give you a particular assignment, so all of you are required to do that assignment on time. Because if you delay the assignment, then it will going to affect your results. So one of the students want me to solve this question. The requirement is the total charge to profit or loss. So what amount that we should have to charge in the income statement in totality. It says that during the year ended 31st December 2004, Blue Company incurred expenditure on two projects, that is project 1 and that is project 2. The cost led to the evaluation of the alternatives for improved production system to be implemented during 2005 and 2006. The company spent 1 million on related salaries and material, of 2 million on design equipment, which had an expected life of 4 years. In project 2, it says that project 2 involved the testing of a new product which will be introduced to the market in 2005 and is expected to generate profits over 4 years period. The company spent 4 million on salaries and material. The policy is to charge a full year depreciation on assets. So the question is, what will be the answer for this question? So for this project 1 million is related to the salaries. So 1 million will be charged as an expense in the income statement, and 2 million on design equipment, which had an expected life of 4 years. So when we divide 2 million divided by 4, it will come a value of, will be, so the total amount that we will charge in the income statement will be 1.5 million. For project 2, we didn't charge anything because the project is not yet completed. It will be completed in 2005 and is expected to generate profits over the 4 years. So as the project is still in the development phase, so you need to capitalize this 4 million amount. So it will be reported in the balance sheet as an asset. Now this one, sometimes the examiner will give you the questions in which you will be asked two accounting standards at the same time. In this question, you'll be having the concept. You have to apply the concept of IS 38 and IS 20 at the same time. So please attempt this one. So the right answer for this question is 400,000. Very good. Abdul Hafiz is absolutely right. The right answer of this question is 400,000. Sorry, time of the fees. Kindly solve. So let's start this question. What amount should be first, in order to solve the question, first you need to read the question requirement first. What amount should be charged to the Design Company statement of profit and loss for the year ended 31st December 2006 to reflect the above transaction? Design Company spends 500,000 on 1st January 2006 spending on its key staff on a one-day training course. Do remember this point that the training cost can never be capitalized, and the reason is the definition. When it's connected with the definition of the asset, we all knew that an asset is a resource controlled by an entity. So you cannot control the employees, therefore we never capitalize the training cost, which took place at the beginning of the current financial year. Dan is expected to benefit from this training for the next 2 years. So it will give you the benefit for the next 2 years, but you cannot capitalize the training cost. The whole amount of the training cost will be charged as an expense in the income statement, that is 5 lakh. This training cost was partly funded by the scheme of the Zan's company received 50,000 from the government before the training commenced. So the training cost is somewhat financed by the government as well. The government is right now has paid you 50,000, and the remaining balance of 50,000 is due to be received in the next year. But the chances for receiving the government grant is, as it is virtually certain, so it should be recognized in the current year. So the government grant as an income will be recognized in the current year. So the expense of 500,000, which is netted off with an income of 1 lakh, so the net expense of 400,000 will be charged as an expense. Yes, I have already marked the answers for your support, because previously I have given this question for the assignment in the last class. So actually the company has incurred a cost of training, which will give the benefit for the next 2 years, but we cannot recognize asset for the training cost according to IS and according to the framework. So we have to charge the whole of the training cost as an expense. So it is the application of the matching principle that you are incurring a training cost in 2006 and you are receiving the grant on accrual basis in 2006. So the related expense should be matched with the related income. Yes, but the part of the grant will be received in current year and the sum of the part of the grant will be received the next year. But this grant is actually related to the training cost, so it should be matched in 2006. Entire amount of expense to be charged in the year 1, yes, yes itself. But 50 will be received in the next year, not received. It is the concept of accrual basis accounting actually. Like assuming if I sold the goods to you on the credit terms and you will pay the cash in the future. So should I record the sales right now or after 1 year? So as you made the sales in the current year, so you have to book the sales in the current year, and payment can be received at the future dates or after a few years now. So if it is probable that it will show virtually certain will be the situation in which you will be having the guarantee that the amount will be received. So if the situation is less than virtually certain, then you cannot recognize this 100,000. Then it will be disclosed. Yes. Okay, here is a question for you. The right answer for this is D, but you should understand the concept underpinned in this question. This question is having 4 parts. The answer is D. So if 4 is the right answer, then you should know why A, 1, 2, and 3 is wrong. Please read this one. Okay. The first part. Green company spent 100,000 providing health and safety training to its staff. So if the company has incurred an amount of expenditure on a training, then it cannot be recognized as an asset or a liability. Green company, the part 2 is the green company has been told by a brand consultancy that the value of its internally created brand is 200,000. As we have discussed in IS 38, that you cannot capitalize the internally generated brand. The third one is the green is showing a supplier of 450,000 for the losses that it suffered due to faulty goods. Green company is likely, though not certain, to win the court case. So the chances is not probable. So we can only recognize a contingent liability when the chances of the payment is probable. So it cannot be recognized as a liability. Green company has sold goods subject to 5 years warranty, on which expect some claims will be made. So you have sold the goods and you are expecting a warranty claim in the future. So it should be recognized as a liability according to the provisions of IS 37. So it should be recognized as a liability. Okay, as I have already told you that the brand, when it is internally generated, you cannot capitalize according to the standard. On this question, you will be having a research and development cost of 40 million, in which the company has made 25 million on the research cost, and research cost will be charged as an expense, and the remaining 15 million will be capitalized if the criteria of IAS 38 are met. And it says the directors are confident that the success of this project will be likely to be completed in March 2005. So this amount should be capitalized as an asset. That's the answer for this question. If there's some students who missed the previous classes, there's a handout section in which you'll be given some handouts. So please download all the handouts from the handout section of day 1 and day 2. So let's start with the new topic, that is IAS 36. I'm going to start this topic, IAS 36. IAS 36 is about the impairment. It says whenever the carrying amount is greater than the recoverable amount, then there will be an impairment loss. So whenever the carrying amount is greater than the recoverable amount, then there will be an impairment loss that we need to recognize. The accounting entry will be income statement debit and asset credit. Income statement debit and asset credit. And if the asset was revalued previously, then the accounting entry will be revaluation reserve debit and asset credit. So the treatment for the impairment loss is very much similar to the downward revaluation that we had discussed in the last class. So carrying amount means the net book value of the asset, and recoverable amount is a technical word that we use whenever we take the higher value from the fair value less cost to sell and the value in use. So if we have got the fair value less cost to sell of 100 and the value is used is 120, then we took the value in use in order to calculate the recoverable amount. So in very simple terms, recoverable amount is the higher of net selling price and value in use. And value in use is the present value of all future cash flows. Now, so in order to calculate the impairment loss, first you need to calculate the carrying amount and the recoverable amount. Recoverable amount is the higher of net selling price and value in use. And if the carrying amount is greater than recoverable amount, then you can say there is an impairment loss. But in case if the carrying amount is less than the recoverable amount, then your answer will be there will be no impairment. So you cannot recognize gain according to this standard. You can only recognize an impairment loss. So there are lots of working that you need to do in order to calculate the impairment loss. Therefore, IAS 36 says that there is no need to calculate the impairment loss or recoverable amount of each and every single asset on an annual basis. So you need to see at each reporting date whether there is any indication that an asset may be impaired. So if there is some indicator related to the asset that tells you the value of the asset has gone down, then you need to calculate the recoverable amount. Otherwise, you do not need to check the impairment of each and every single asset. So first you need to check the impairment indications. Impairment indication means any sign that tells you that the value of the asset has gone down. But there are certain assets on which you need to calculate the recoverable amount on an annual basis, whether or not there is any indication. So what are these assets? Intangible asset with an indefinite useful life, intangible assets not yet available for use, and goodwill acquired in the business combination. So these are the three assets for which we check the impairment and calculate the recoverable amount on an annual basis. Second concept, according to IS statistics, is the CGU, cash generating unit. Cash generating unit in which we'll be having a group of assets. Group of assets. Sometimes it is impossible to calculate the recoverable amount of a single asset. An entity will need to calculate the recoverable amount and the carrying amount of group of assets. So what is CGU? CGU stands for, the definition is the smallest identifiable group of assets that generates cash inflows. So the smallest group of assets, or the smallest unit of the group of assets that generates independently cash flows that are largely independent of the cash inflows from other assets or other groups. Okay. So when we are going to calculate the impairment loss of a CGU, the format will be same. You need to calculate the recoverable amount of a CGU, then carrying amount, and if the carrying amount is higher, then there will be an impairment loss. But this loss should be allocated on different assets in a group. But it has some rules through which we allocate the impairment loss. So what are the rules for the allocation? So first we need to reduce the carrying amount of any goodwill. So if there is a value of the goodwill in the CGU, then the whole amount of the loss will be charged in the goodwill. So these 2 points are written in the standard, but there is one more thing that we use in solving the question, that is obvious impairment. This word was not written in accounting standard, but it was used practically when we allocate the impairment loss. First, you need to allocate the obvious impairment. Then the second amount will be on the goodwill, and then reduce the carrying amount on any assets on pro rata basis. Pro rata means weighted average. But do remember this point, that impairment will never be allocated on current assets. We never allocate the impairment loss on current assets. Okay, just face type to just the space. Yes. Can you please explain the point, intangible assets not available for use? Intangible assets not available for use means that's assuming that you have acquired a license for doing a business, but your business has not yet been started, or you have acquired a software and you haven't started using that software. So these are the examples for the intangible assets not yet available for use. What about the asset damage? We should allocate that it after the goodwill. No. If there's an asset damage, then it will be considered in obvious impairment. So specific information about a particular asset will be considered as an obvious impairment, which should be charged first. Then the second amount will be allocated on goodwill, and the remaining amount will be on the remaining non-current assets on pro rata basis. If the market value increases, then we can say that there is no impairment. Amount of the current assets will be included in the CGU, but you will not charge the impairment. Yes. Yes. You're right. For clarity, first on asset which are damaged, second goodwill, third pro rata basis. Let's solve a question. This is one of the questions for you guys. I want all of you to please do attempt it. But first read the requirement of the question. There are certain students who are giving answers on the WhatsApp group. I want all of you guys to give your answers in the chat box rather than on the WhatsApp group. Yes, the right answer is A. Very good. This is the chat box. And Abdul Sayyid Abdul Mueez Ali, where you're writing. This is the chat box. You can see on the screen there is an option of chat where you can write anything. Mm. So the right answer is A. Do you people want me to solve it or should we go further? Let's see. So there are some students who want me to solve. So I think it will take hardly a few minutes to solve it. The carrying amount of the CGU is 300,000. The recoverable amount is 200,000. This is one of the past paper question. Impairment loss will be 1 lakh. So first of all, you need to see whether there is an obvious impairment. No, there is no obvious impairment in this question. Then you need to allocate the whole amount on the goodwill impairment loss, and the value of the goodwill is now 0. So out of 100,000, you have allocated 50,000 on the goodwill. So the remaining unallocated amount is 50,000. And we all knew that we cannot allocate the impairment on the net current assets. So we only have two assets, that is property, plant and equipment with a value of 2 lakh and a product patent having a value of 220,000. So you need to take the weighted average. So the weightage for this asset will be 200 divided by 220. Multiply by 50,000, so amount will be 45454. And the right answer will be 15455. So this is how we've done this question. A theoretical question for you guys. The question is, which of the following is not an indicator? That means there are three indicators for the impairment and there is one answer which is not the indicator. I think there are some students who have learned this question. So I'm restricting the rights in the WhatsApp group so that the students will give the answers on the chat box rather than on the WhatsApp group. Okay, the right answer is D. Okay, for those students who haven't joined the WhatsApp group up till now, I request all of you and the management to please share the link of the WhatsApp group and my contact number. If you will not be able to join the group, please send a message on my number on the WhatsApp. I will add you tonight. You don't need to worry about it. So the right answer is D. That means D is not an indicator, but A, B, and C are indicators. So these are the points that tells you that there is an impairment indication. Like when there is a technological advancement, we all knew that the value of the previous technology goes down. Similarly, when there is an increase in the interest rates, it will affect the buying power of the economy, and definitely it will reduce the demand. And if it affects the demand, then definitely there will be a downward trend in the prices. The carrying amount of net assets is higher than the entity's number of shares in issue multiplied by the share price. It means that in the market, the share price is even less than the par value. So suppose you have got an asset of shares having a par value of $10, but currently its market value is $2. So it shows that the share price is even lower than the book values. There are two ways in which you can understand the point B. The first thing is whenever there is an increase in the interest rates, actually the amount of the investment that the economy has will go into the banks because the banks are giving them higher returns and there is an increase in the interest rate. So if your investment goes into the bank and is stuck in the bank, then it will affect your buying power. So if you have got the weak buying power, that it means that it will affect the demand in the economy. So if you have got enough supply in the market, but the demand is decreasing, then definitely it will decreases the price. That's the economics point of view. The second way to understand this point is when we calculate the present value of the future cash flows, we take the discount factor of interest rate. So if the interest rate is increasing, then it means the present value of the future cash flow will go down. So if the value is decreasing, that means it will affect the recoverable amount, and definitely there is an indication of impairment. So part C is saying that your share price is below the par value. And part D is saying that the net realizable value has reduced, but even in this situation, it is greater than the carrying amount. So there is no impairment even in the inventory. Now, let's solve this question. The question is related to brand, which is recognized on the balance sheet. That means definitely it will be a purchase brand because we cannot recognize an internally generated brand. So it is definitely a purchase brand, and for which you need to calculate the carrying amount and the recoverable amount. And if the carrying amount is greater than the recoverable amount, then you need to recognize an impairment loss. Please do solve this question. I'm giving you 30 seconds. So let's start the question. On 1st October 2005, you will be given the cost of the brand as well as its accumulated depreciation, and Snowdown's brand and the trial balance relates to the product line that received bad publicity during the year, which led to the falling the sales revenues. This will be considered as an indicator for the brand. An impairment review was conducted on 1st April 2009. So 1st April 2009 means from October 2005, 2008 to April 2009. So October, November, December, January, February, March. So after 6 months. So first of all, you need to calculate the carrying amount after charging a depreciation of the 6 months. The carrying amount will be 30,000 minus 9,000 minus the useful life is 10 years. So the annual depreciation will be 30,000 divided by 10. It will be 3,000, and for the first 6 months, it will be 1,500. So when we deduct 9,000 and 1,500 from the 30,000 figure, you get the value of 19,500. Talking about the recoverable amount, it says the value in use is 12 million and the net selling price is 15 million. So in order to calculate the recoverable amount, we take the higher amount of net selling price and value in use. So the higher figure is 15,000. So here you can see the carrying amount is greater than the recoverable amount. So there will be an impairment loss of 4,500. Very good. How we know the life is 10 years? It's mentioned here. You can see on the screen. Now the next standard is IFRS 5. That is non-current asset held for sale. Now the remaining life of the value in use is not relevant here. It will be used for the subsequent depreciation. Yes, falling in the sales revenue or decline in the profitability will be considered, can be considered as an indicator. The requirement of the previous question was to calculate the impairment loss simply. Now, I think there are students who want me to tell them about the future depreciation for this question. So when we charge the depreciation, the value is now 15,000 divided by remaining useful life, which says the remaining life of this brand is now 3 years. So it will be divided by 3, and for the last 6 months, the depreciation will be based on 6 upon 12. So if someone wanted to know the depreciation after impairment loss, the amount will be 2,500. So for the first 6 months, the depreciation will be, so in the income statement, if someone asks you to calculate the value of the income statement, depreciation is 1,500 for the first 6 months and 2,500 for the last 6 months, and there will be an impairment loss of 4,500 that will also go in the P&L. I hope it's clear. Impairment is 4,500 and subsequent depreciation is 2,500. And if you wanted to know about the balance sheet, in the balance sheet, the asset will be reported at 15,000 minus 2,500. Now the next standard is IFRS 5. When would we calculate 2,500? 2,500 will be used if the question asks you to calculate the depreciation for the last 6 months after the impairment. Because the impairment was occurred at the mid of the year. So after the impairment, you need to calculate the depreciation for the last 6 months. Okay, it's about the non-current assets held for sale. So we all knew that when we prepare the balance sheet, the asset section will be having two categories of the asset. First is the non-current asset, and the second category is the current asset. IFRS 5 only says that if you are going to dispose of a particular non-current asset or group of assets called disposal group. So if you wanted to sold these assets in the near future, then it should be classified here with the name held for sale. So those non-current assets which will be sold in the near future, or the company is planning to sold that as these assets in the near future, then these assets should be reported separately with the name held for sale. That is the requirement of IFRS 5. And when we place these assets into held for sale, then there will be no depreciation. So no depreciation will be charged on the assets classified under held for sale category. So the standard exactly specifically does not mention that it should be classified in current assets. So we report the held for sale separately from the current assets. Like when we are doing the presentation, assuming we have got inventory in the current assets, receivables in the current assets, cash in the current assets, then held for sales should be reported separately from the current assets. Should not be mixed up with other assets of current assets. But if not so, we have to charge a depreciation. Yes, after a gap, totally separate. But in order to classify a non-current asset into held for sale, there are certain criteria of IFRS 5. The first one is the management must be committed to a plan to sell that. The asset must be immediately available for the sale. There must be active program to locate a buyer. The sale must be highly probable, means it should be done within next 12 months. The asset is being actively marketed at a reasonable price, and there is an unlikely chances that the company will withdraw or change the plan significantly. So these are the basic points that should have to be met in order to classify a non-current asset into held for sale. So when we are going to transfer the asset from non-current asset to into held for sale category, asset will be measured at the lower of carrying amount and fair value less cost to sell. Carrying amount and fair value less cost to sell. So suppose if the carrying amount is 100 and fair value less cost to sell is 60, so asset will be reported into held for sale category as 60, and the difference of 40 will be recognized as an impairment loss. So this is also an impairment loss. The question is, in the ratio, will the held for sale items included as current, as such as included as current asset ratio? Yes. Whenever you are going to calculate the current ratio, you have to include the assets. Management commitment is verified by any declaration. Yes. Do not think about an auditor. So these are the work of the auditor to verify whether the management is committed or not. So you're right. There must be some declaration. There must be some board meetings. There must be some minutes of the meetings, so which the auditors verify their management intention. So the last point is, the action required to complete the plan indicate that it's unlikely that the plan will be significantly changed or withdrawn. And I have discussed that whenever you are going to shift a non-current asset into held for sale category, then asset should be measured at the lower of carrying amount and fair value less cost to sell. And after that, there will be no depreciation. Okay, sometimes company is going to sell a single asset, which might be a building. So building is a single asset. So we use the word non-current asset held for sale. But if the company is going to sell its factory, the factory means this is not a single asset. This will be group of assets. That includes the machinery, the building, the related furniture, in each and everything that is used for the factory. So the words we use will be the disposal group. In ISRC, we use the word CGU for group of assets, but here we use the term disposal group when we are going to sell the group of assets in a single transaction. So the pattern for the measurement will be similar: carrying amount and fair value less cost to sell. And difference will be recognized as an impairment loss if there is a loss. But the allocation of the impairment loss will be according to the requirement of IS 36, which says that first you need to allocate the impairment on the obviously impaired assets. The second one is the goodwill, and the third one will be on the assets on pro rata basis. Is the asset held at cost model or the revaluation model? It could be measured in previously at the cost model or revaluation model, but once it is being transferred to the held for sale category, then it will be measured at the fair value less cost to sell and the carrying amount, whichever is lower. And we do not charge any depreciation. We do not do any sort of fair valuation measurement. So all you need to do is to calculate the fair value less cost to sell till the time you sold the asset, and if there's an impairment loss further, then you can recognize the further loss. Now, at the time of the classification and held for sale, it says that immediately before the initial classification of asset as held for sale, the carrying amount of an asset will be measured in accordance with the applicable IFRS. Like suppose if you have got the tangible non-current asset before the classification to held for sale, then it will be measured at IS 36, sorry, IS 16. If you have got the intangible non-current assets, it will be measured at IS 38. So before the classification to held for sale, asset will be measured and the carrying amount will be calculated with reference to the applicable IFRS. After the classification as held for sale, non-current asset or disposal group that are classified as held for sale are measured at the lower of carrying amount and favorable less cost to sale. And the difference will be recognized as an impairment loss. And no depreciation will be charged on the assets classified as held for sale. So I'm sharing a question for you guys. Please do attempt it and reply your answers in the chat box. You have 30 seconds to attempt this question. The time starts now. Yes, the right answer for this question is C. Very good. The right answer is C. As 68.36.8 is the favorable cost to sell, which is lower than the carrying amount. Carrying amount of this asset will be is 37.5. So we took the lower amount. Another question for you guys. Yes, if it's not sold at the after the year end, then there are some provisions of IS 36, uh, IFRS 5, that you need to charge the whole depreciation again. 37.5 is the carrying amount after charging depreciation. So students are stuck in this one, and they want me to solve it. 30th September 2013, June property statement, financial statements. We have been given a cost of 45 million and accumulated depreciation of 6 million. On 1st April 2014, June decided to sell the property, and the year end is September, before the 6 months. So first, you need to charge a depreciation for the 6 months. 45,000 divided by 15 years multiplied by 6 upon 12. The amount will be 1,500. So in order to calculate the carrying amount, the amount will be 45,000 minus 6,000 minus 1,500. So this is how we have calculated the figure 37,500. Then fair value less cost to sell. You can see here the price is 42 million. That is the fair value, but it says because of the tough market conditions, the prices is less than 10%. So you take the 90% value of 42. 42 into 90% value, it will be 37,800. That is the fair value revised. Less the cost to sell is 1 million. The amount would be 36,800. And it should be measured at the lower. Another question for you guys. Please do attempt it. Yes, very right. The right answer is A. A is the right answer for this question. Now, moving on towards the next point. Now, the next point part of the standard is about the discontinued operations. Students want me to solve it first. I'm going back again. The carrying amount on 1st April is 800,000, which had a remaining life of 16 years. The property has not been revalued on 1st October 2014, again after 6 months. So need to revise the carrying amount first by deducting the depreciation for the 6 months. So 800,000 divided by 16. So the amount will be 50,000 for the whole year. And for the last 6 months, 800,000 divided by 16, it will be 50,000. And for the 6 months, it will be 25,000. So the carrying amount will be 8 lakh minus 25,000. It will be 775,000 carrying amount. And fair value less cost to sell is 790,000. And IFRS 5 says that you need to report held for sale assets at the lower of the carrying amount and fair value less cost to sell. The carrying amount is lower, therefore the right answer is A. I hope it's clear now. And in the P&L there will be nothing. It will go in the income statement. When you prepare the income statement, only the depreciation for the first 6 months will be charged, because in the last 6 months we don't need to charge any depreciation. And in the balance sheet, asset will be reported with the name of held for sale at a value of 775. That's the requirement of the test. Now the next area is about the discontinued operations under IFRS 5. It says that if you are going to discontinue your operations either through close down or you are going to sell your operations, then it should be reported separately. So how we present it in the income statement? So first of all, you need to report the sales of the continued operations, the operation which you are going to continue in the future, cost of goods sold for the continued operations, gross profit for the continued operations, expenses for the continued operations, and then finally you calculate the profit from the continued operations. And the discontinued profit or loss should be added or subtracted from here in order to calculate the total profit for the year. So if the company is going to close down or is about to sell its some of the operations in the near future, then these operations are called discontinued operations, which according to IFRS 5 should be reported separately. Held for sale is all about assets and balance sheet, and discontinued operations is all about the income statement and cash representation. So held for sale is about the balance sheet and discontinued operations is about the income statement presentation. So the profit or loss from the discontinued operations should be reported separately. This is the requirement of IFRS 5. So let's solve this question in which you are required to calculate the profit or loss on the discontinued operations. Just read the question and you are required to calculate the profit or loss from discontinued operations. So the revenue from the discontinued operation is 15,200. The related cost is 16,000. Operating expenses is 3,200. Plus there will be a penalty cost of 1,500. So after deducting all these figures, we got the value of 5,500. So that is the loss from discontinued operation. And these are the operations which the company is going to close down in the near future. Because it's a loss making unit. But what you need to do in the exam question, that if it comes in the examination final account, so first of all, out of the total sales of the company, you need to deduct 15,200, because 15,200 is the revenue from the discontinued operation. Similarly, from the cost of goods sold of the whole company, you need to deduct 16,000 cost of goods sold, and from the operating expenses of the whole company, you need to deduct 3,200. So that we got the value of continued operations, sales, cost of goods sold, and operating expense. And the values for the discontinued operation will be calculated separately, and the net amount will be reported after calculating the profit from the continued operation. Okay. So first of all, you need to deduct the results of the discontinued operations from the total sales, cost of goods sold, and operating expenses. So that you got the final value of continued operations only. Like suppose if the total value of the sales is 1 lakh and discontinued operation has got the sale of 15,200. So the rest amount of the remaining sale will be related to the continued operation. So everything should be deducted in order to calculate the results of the continued operations, and then the profit or loss from the continued discontinued operation will be reported at the end. Yes. So do we recognize 1,500 too? It is a present obligation on the cost here. This 1,500 is a loss. What is the present obligation from the past year? Where does the penalty go? Penalty will be recognized as an expense. Where the 1,500 will be? 1,500 will be charged in the discontinued operation results. Discontinued operations will be separately calculated. In fact, it is the income statement of discontinued operations, and the final result will be reported with the income statement. Like if I show you the format again on the previous slide, you can see here that in order to calculate the sales, you need in order to report the income statement, you need to report the sales of the continued operations only. So the result of the discontinued operations is already deducted from here. Then cost of goods sold continued operations, of gross profit continued operations, the result of the discontinued operation will be reported at the bottom only. $1,500 is actually the penalty cost that you need to incur because you are terminating the lease agreement of this particular venture early. Therefore, they have to pay the penalty cost. So this penalty cost is actually related to the discontinued operation. So it will be considered as an expense for the discontinued operation. Therefore, we have deducted its profit before interest and tax. So let's move on towards the next standard. Which kit is best? One of the students is asking for the which kit is best. I would recommend the people to do both the Kaplan and the BPP kit for section A and B. That's the highest recommendation. But if you have got the enough, if you do not have got the enough time, then Kaplan is better. Total loss will be 5,500. Will not be. I don't know how you calculated this 9,500. Total loss is actually 5,500. Okay, IS 40 is about the investment property. Investment property, this standard is only applicable on the properties that will be land and building. So this standard is only applicable on land and building, which the company acquired or construct for future rentals or a long-term capital appreciation. So if you have got the property, property means land and building, which you acquired or construct for the future rentals or capital appreciation, then it will be considered under the scope of IS 40. IS 40 says that you can measure the investment property at the cost model, which is similar to IS 16, or the fair value model. This standard has got the fair value model. And what is fair value model? Fair value model says that on an annual basis, you need to measure the fair value, and all gains and losses will be recognized in P&L. And no depreciation will be charged on the assets measured at the fair value. If I show you the example from the examination question, available in the past paper, then this could be the example. Please read this line. This is related to IFRS 40. It says that when company revaluates its investment property, that means the company is following the revaluation fair value model, in which we do the fair value measurement on an annual basis, and any gains and losses will be reckoned in P&L, and no depreciation will be charged on investment properties. So it says that investment property increased in the value by 4 million. So there is an increase in the value of the investment by 4 million. So how we can record this transaction? How we can record this transaction? So the accounting entry will be investment property debit by 4 million, and income statement will be credited by 4 million. So there will be a gain of 4 million in the income statement. It's very simple, I think. Is it clear to all of you? Okay. So there is a The concept of transfers, that is important with reference to the MCQs. So if there is a transfer from investment property to the property, plant and equipment, that's an important part. So the examiner might ask you the where the gain and loss will go. So when there is a transfer from the investment property to the property, plant and equipment, that previously we have acquired the property for investment purpose. Now we are using this property for the business purpose. So if you are using that property in the business, then it will be considered under the scope of IS 16. So there is a transfer from 40 to 16. So it says that the gains and losses will go in the profit and loss. But in case from property, plant and equipment to investment properties, if the situation is opposite, then the gain and loss will go in the revaluation surplus. That's the important point. Now, gains and losses are recognized in income statement. I haven't used the word other comprehensive income. So these are realized gains and losses. It will be reported in the income statement. For this investment property, why can we can realize the gain immediately in the period? Yes. Difficult for other properties? Yes. Very good. Can there be a surplus and the fair value gain in one scenario? Can there be yes, revaluation surplus is related to actually IS 16 and fair value gains are related to IS 40. So these are separate standards. Yeah, we will put the gains and losses from the date when it moves from, actually when we move from 40 to 16 or 60 to 40, we need to compare the figures with the current market value. So if there is a gain or loss, then where we this gain or loss will be reported. So these are the guidelines of IS 40. That if the transfer has been made from the 40 to 16, the gain will be reported in P&L. But if the transfer was made from the 16 to 40, then the gain will be reported in the revaluation surplus. So in a very simple way, you can say that the rules of the previous standard will follow. Yes, fair value gains of IS 40 will directly be reported in P&L. Yes, if there is a surplus in the revaluation, then this will also be reported in the OCI. I think it's clear now. If you have got any confusions regarding my point of view, then you can ask questions on the WhatsApp with me, or you can review. There are some students who want me to repeat the points. So I request all those students to will be having the link of the video, so you can listen to these videos as many times as you want. Say the difference between revaluation gain and surplus. Revaluation gain and revaluation surplus is similar. Revaluation gains will go in the revaluation surplus account actually. If what about the depreciation? If the investment property to PPE, what about the depreciation? Depreciation will be charged from the date that we will be transferred in PPE. Revaluation gains are actually gains which are reported in the revaluation surplus account. So I think it's similar. So revaluation surplus is the name of the account actually. The depreciation will be charged from the day of the transfer. I think I have given all the answers. So the last standard before the break, that is about IS 40, which is very easy to understand accounting standard. IS 40 is related to biological assets and agricultural produce. Agricultural produce and biological assets. Biological assets means plants and animals, living plants and animals. So if you have got different animals and you are doing business with the animals or plants, then this, the provision of the IS 41 will apply. Similarly, agricultural produce is the harvested product from the biological assets. Harvested product from the biological assets means from a cow, we take the milk. The milk will be considered as a agricultural produce. From a mango tree, mango will be considered as a agricultural produce. So both the biological assets and the agricultural produce will be measured at the fair value less cost to sell. And its gains and losses will go in P&L. Very simple. But only if the fair value less cost to sell is not available, like it is difficult to identify the fair value of that asset, then it will be measured at cost less accumulated depreciation. Like suppose you have got a different cow from Australian cow, and you don't have the updated fair values of these cows, which are unique in nature. So these cows will be measured at the cost less accumulated depreciation. Depreciation will be based on their useful life. Crops is also agricultural produce. Biological assets means plants and animals. But there is one type of plant with the name bearer plant, which are covered under the scope of IS 16. So bearer plant has got the definition, and its definition is like if it is going to give you benefits for more than one accounting period, then it will be considered as a bearer plant. So in fact, the mango tree is bearer plant. Coconut tree is bearer plant, but the sugarcane plant is not a bearer plant, because after every year it will be harvested. Now, wood will be considered as a agricultural produce initially, and then it will be considered in the inventory. Now, for the agricultural produce, it says that whenever the agricultural produce will be detached from the biological asset, then it will be considered as a inventories. So if the mango is still on the tree, then it will be called agricultural produce. But the moment when we detach the mango from the tree and we are going to sell these mangoes to outside the world, then it will be considered as the inventories of the business. So all agricultural produce actually are inventories. So the mangoes will be agricultural produce till the time it is attached with the tree. And the moment you detach that mango and you are going to sell those mangoes to the customers, then this will be considered as your inventory. Similarly, the time you extract the milk from the cow and you are going to sell those milk to the customers, then it will be considered as inventories. The biological transformation. Okay, any type of gains or losses that we book on the transformation of the biological assets, like because of the birth or because of some physical changes, it will be reported in P&L. So next accounting standard is IFRS 16, that is related to leases. I think let's take a break of 5 minutes, and after the break, we will start the session again. So 5 to 10 minutes break, and we will start after the break. Thank you so much. Okay, welcome back after the break. Let's start the session again. Please write in the chat box if you're ready and you can hear my voice clearly. So let's start with the topic. IFRS 16 is about the leases, and the new model for this standard is the right to use model, in which every lease should be accounted for in a similar pattern. So for all the lease transactions, first you need to record right to use the asset debit, cash credit with the initial deposit, and lease obligation credit with the present value of future cash flows. Cash will be credited with the initial deposit. If you have got any initial deposit, then it will be recorded with the cash. One thing that is very important for IFRS 16 is that in which you need to calculate the value of the asset and the liability at the same time. So asset and liability will be measured at the same time. Asset will be depreciated over its useful life, and lease obligation will be amortized. The most important point for this standard will be this standard will not apply to leases of low value items and leases up to 12 months. So the lease period is less than 12 months, then this standard will not gonna be applied, and this standard will not be applied on low value assets. So it will be applied on high value assets only. So this standard will be applied on high value assets or the lease period is more than 12 months. Future cash flows. FCF means future cash flows related to the lease. Now here we have got the question for you. So as it is the first question, so I'm solving it for your guidance. On 1st April, SIMA related into an agreement to lease an item of the equipment. The lease required 4 annual payments in advance of 215,000, commencing from on 1st April 2007. The equipment has a useful life of 4 years. So the first accounting entry that you need to make will be right to use the asset debit, cash credit, and lease obligation. Here you can see the total lease payments. The present value of the total lease payments will be 7,50,000. So lease obligation will be recognized at 7,50,000. There is no initial down payment, so the asset will be recognized at the same amount. So first of all, you need to record this transaction, and after this asset will be depreciated at the lower of the useful life or lease period. The asset will be depreciated at the lower of useful life and lease period. And in this question, both values are 4. 7,50,000 will be divided by 4 years. So we got the value of this depreciation. So 750 divided by 4. So the amount will be 187,500. So this asset will be depreciated. and this lease obligation will be amortized. For this, you need to make the amortization table. For the year one, obligation at start is 7,50,000 plus interest will be charged at 10%, which will be 75, and the company is making a payments of 215, and you can see this is an advanced case. So the difference between the table amortization table of advanced case and in arrears case. Like in advanced case, we made the table like obligation at start. Then first we need to deduct the payments, which is 215, and then interest will be charged in it, and then obligation at end. So the first format is for arrears situation, in which the company has make all the payments at the end of the period, arrears, and the second format is for advanced situation, in which the company made all the payments at the start of the period. So if you make the payments in advance, then 215, and interest will be 53.5, and the obligation at end will be 588.5. And in arrears case, first you need to charge the interest, which is 75, then we make payments 215, the amount will be 610. So is it clear? Low value items are subjective in nature, so examiner will tell you if the question is about the low value item. Asset, in both the cases, asset will be depreciated at a value of 7,50,000. Now, as the situation is for the advanced case, I'm making the table again. Obligation at start is 750. First, we need to make the payments. That is 215. Then interest will be charged at 10%, which will be 53.5, and obligation at the end will be 588.5. This obligation should be broken down into current liability and non-current liability. So it's very simple to calculate the current and non-current liability, and the installment that we are going to pay in the future in the year 2 will be the current liability, and the remaining balancing figure will be the non-current liability. 588.5 minus 215 will be, the amount will be 373.5. So this is how we have calculated the current liability in in advanced case the finance cost will be 53.5. If there is a difference between the useful life and the lease period, then we use whichever is lower for the calculation of depreciation. Out of 588.5, 215 is the current liability, and the remaining balanced figure will be the non-current liability. So if you deduct 215 from 588, you got the value of 373.5. 53.5 comes from is when you deduct 215 from 750, it will be 535. And then we take 10% figure of this, which will be the finance cost. The finance cost in advanced case will be calculated after deducting the installment. Now for this case, this question, in the income statement, there will be a depreciation of 187,500 and a finance cost of 53,500. So these are the two items which will be reported in the income statement. With respect to the balance sheet, asset will be reported at 750 minus 187.5, and liability will be broken down into current and non-current liability with the name lease obligation. So the part of the lease obligation will be reported in current liability and the remaining amount will be reported in non-current liability. So this is how we present this question into the financial statement. By dividing the value of the asset by 4, because 4 is the lease period and also the useful life of the asset. So 7,50,000, which is the value of the asset, divided by 4, you will get the value of depreciation, which is 187.5. So moving on towards the next slide. Here is a question for you guys. I want all of you to please do attempt this. In this question, you are required to prepare the table on areas basis. Now I'm going to solve this question. Right to use the asset, debit, cash credit, and lease obligation credit. These obligations will be credited with the present value of the future cash flows, which will be 31,552. Initial deposit, initial direct cost that the company is going to pay is 3,000. The asset will be debited by 34,552. Now we are going to make the table. Obligation at start, 31,552 plus interest will be charged at 5%, minus payment will be made at 10,000, and we got the value of obligation at N. So 31,552 into 0.05, the amount will be 1577.6. So obligation at end will be minus 10,000, 23,129.6. So in order to calculate or break the value into current and non-current liability, you need to prepare the amortization schedule for the second year as well. So if you prepare the schedule for the next year as well, then it will be very easy to calculate the current and non-current liability. So 123.12916 into 105, the interest will be 1156.8 minus 10,000. The closing liability that will be reported at this point will be 129.6, 23129.6, 1.05 minus 10,000, 14,286.08. So if you compare these two liabilities, you will come to know that out of 23,129, 142.86.08 will be the non-current liability, and the remaining amount that will be paid between the 2 years will be considered as a current liability. So the current liability in this question will be 23,129.6 minus the amount of the liability which is still outstanding. So the amount will be 8843.5. So this is how we calculate the current and non-current liability. So in Arias case, if you wanted to calculate the current and non-current liability, you need to make 1 year's more table. In fact, the table for the next year in order to calculate the current and non-current liability. But in advanced case, it is very easy to calculate the current and non-current liability because current liability will be considered as an advance payment or installment, and the remaining amount will be the non-current liability. Now, for the balance sheet, we charge a depreciation. Value of the asset is now 34,552 divided by the useful life or the lease period, whichever is lower, which is 3 years. The depreciation will be 34,552 divided by 3, it will be 11,517. This is my depreciation. So if you people have any question, please do ask it immediately. There's few. I have come across where we deduct the initial deposit from the present value. When we do, we never deduct the initial deposit. You are actually mixing this transaction with financial instruments. We actually deduct the initial deposit, initial direct cost from the financial liability. So in leases, we always capitalize the initial direct cost. What will be the finance cost? Finance cost will be in this question 157.15 for the first year, 1577.6. Depreciation will be based on the useful life and the lease period, whichever is lower. Yes, all in advance payments, only the cash payments will be the current liability. Payments plus direct cost is the right to use the asset. Yes. How we can calculate the non-current liability in case of arrears? In the case of arrears, all you need to do is to make 1 year more table, and the difference which will be paid between the 2 years will be the current liability, and the amount still outstanding at the end of the 2 year, second year, will be the non-current liability. So whatever is left at the end of the second year will be non-current liability, and the difference between the first year and the second year liability that we have paid will be the current liability. But direct cost is not included because direct cost, we have paid the amount of the direct cost separately, and we have paid this amount already. That's why it should not be the part of the liability. Liability means that you something that you need to pay. Uh, is there any clue in the question that will aid me to know that I am create the lease liability table for 1 year or 2 year or 3 years as the case may be, or for some question that we have to make for more. Okay, the clue is you need to see the timing of the installment. If the company is going to make the payment of the installment in advance, and company wanted to know about the current year, that's 2000, assuming 2019. So you only need to prepare the T account or the amortization table for 1 year. That's it. Because the case is for the advance. But suppose examiner asks you to calculate the obligation for 2019, but all the payments were made at the end of the period. That means these are the case for the areas. For the areas case, you need to make one more years table so that you can calculate between these two liabilities, this point and this point. Whatever we have paid between the 2 years will be the current liability, and the amount is still outstanding at the end of the second year will be the non-current liability. When the policy is to retain a control, what amount should be shown in the statement of financial? So in the statement of financial position, asset will be reported after deducting the depreciation. Now, there is a one point that I need to discuss about the depreciation, that asset will be depreciated at the lower of useful life and the lease period. Asset will be depreciated at the lower of useful life and lease period. But if the question tells you that the asset will be transferred to the lessee at the end of the lease period, what means that the lessee will be the legal owner of this asset after the lease period, then in this situation asset will be reported at the useful life only, depreciated. So if the question is neutral, then asset will be depreciated at the lower of useful life and lease period. But if the question specifically tells you that at the end of the lease period, lessee will be the legal owner of this asset, means the risk and rewards of the ownership will be transferred to the lessee at the end of the lease period. Then this asset will be depreciated now at only useful life. You don't need to consider the lease period in this case. What about the initial deposit? You have to capitalize. Do remember this point. Initial deposits are capitalized in case of assets. So this initial deposit is related to the asset, so it should be capitalized. So that's why we have added, it should not be deducted from the present value of the lease payment. Discuss operating and finance laws. Operating and finance is obsoleted. It was discussed in IS 17, which is no longer the part of the course. So now here is the exam question for you, all of you guys. You are required to attempt this question and give your answers. You have 1 minute to solve this. The payment, do remember this point, the payment of 15,000 was made in arrears. Clearly mentioned here, the payment has to be made in arrears, so that's why you need to make the T account for 2 years. If the question asks you about the liability, but it was asking about the right to use the asset only. The right to use the asset will be debited by 100,650, and lease obligation will be credited by 100. There is no initial down payment. Then asset will be depreciated at the lower of lease period and useful life. Now the question says that the present value of the lease payment was estimated to be 100 at inception and the rate of the interest is 8%. Both the lease terms and the plant useful life was 10 years. So it should be divided by 10. So the 100,065 will be the depreciation for the whole year. And as we have acquired the asset on 1st April, so you need to apportion this depreciation over the period from January, March, April, May, June, July, August, September, October, November, December, into 9 months. So the depreciation will be 7548. For 9, we round up the data. 100,065 minus 7548. 7549. So they are talking about the income statement figure. The depreciation will be 7549. So the answer will be C. What total amount? Sorry, it's about the what total amount should be charged. So you need to check the finance cost as well. Year one obligation at start 100,650 and plus interest for the 9 months minus payments and obligation. So when we calculate 100,650 into 1.08, 108, the amount would be for the 9 months will be 6037. So by adding the figures of depreciation plus finance cost 7549, the amount will be 1540. So it's very important to read the requirement very carefully. I just read this portion and this portion. I just ignore actually this part of the question. That's why I've calculated the depreciation only. I was just thinking about that they wanted to know about the depreciation. But when I read the whole requirement, what this and that is what is the total amount that should be charged to the profit and loss. So whenever the question tells you about the total amount that should be charged in the profit and loss, that might include some expenses, some incomes, or some gains and losses. The expenses, there are two types of expenses related to this particular standard. The first is the depreciation, and the second one is the finance cost. I hope it's clear now. I have simply just divide 100,650 divided by 10, and I have taken 9 upon 12 of this value, and we got the value of 7549. 6039 is the 9 months interest. You can calculate the interest by taking the 8% of this amount into 9 upon 12, because we have to charge 9 months interest. Now, one more question for you guys. Take this question as a challenge for you, and the question is the past exam question, and you can see the requirement is very much similar. What is the total charge to the statement of profit and loss? So you are required to solve this one. So the right answer is B. Do you people want me to solve it? I think it's quite similar. So these are the questions which are doing practice in these slides are, according to the examiner, are the most difficult questions from the students' point of view. But mostly students have done these questions and attempted these questions wrongly. John Thomas, I think you didn't capitalize the direct cost. Amortized, actually, these liabilities also a financial liability. So when we are talking about the amortization table and the amortized cost, these treatments are similar. Are they both the same? Yes, both are same, but they are dealt with the different accounting standards, but the treatments are very much similar. Students want me to solve the question. Okay, right to use the asset will be debited. Cash credit with the initial deposit 37500. Lease obligation will be credited by 4657500, and asset will be recognized at 4657500 plus 37500. It will be 46950. So the depreciation of the asset will be based at 4695000 divided by the useful life, which is 8 years, and from 1st July till the year end is June. So 4695000 divided by 8, got the value of 586,875 for the depreciation. For the amortization table, first you need to make the obligation at start, which is 4657500, plus interest will be charged at 6% for the whole year. So when we take the full value of 4657500 plus interest of 0.06, the amount will be 279. So by adding these two figures, 586, 875, we got the value of 866. Include both depreciation charge, right to use, yes. When they talk about the income statement related to the right to use the asset, you need to report the depreciation as well as the finance cost for the lease liability. So the hint is here. It says the total charge to the statement of profit and loss. So when it says the total charge, so that means there must be two or more items. So one thing is the depreciation charge, and the second one is the lease obligation, interest cost. New standard IFRS 15, revenues. Amortization Amortization charge, yes, is the interest cost, yes. We we never deduct deduct the initial payments from the lease liability, because the lease liability is separately calculated and initial payment is separately calculated. So these two are separate things. We never uh, deducted the amount of the initial deposit from the lease obligation, or even neither we add back the figures. Okay, there are certain topics which we are not covering because of the fact that these topics are not important in this session. In fact, for this session for March 2021. So I'm just covering out only those part of the IFRS which is relevant and which is important for this 21 session. So let's move on towards the next point, that is IFRS 15. IFRS 15 is about the revenue from the contracts with the customers. Uh, it tells us that all types of revenue contracts should be considered in 5 steps. The first one step is to identify the contract, then identify the performance obligation, the responsibilities attached with the contract, then the transaction price of the contract, and allocate the transaction price to all the responsibilities, the performance obligations, and recognize the revenue only when the performance obligation is satisfied. So revenue will only be recognized when the performance obligation is satisfied. Okay. So there are cases related to the IFRS 15. So first case is about the financing element. Financing element means if there is a cash transaction and if it is a credit transaction. IFRS 15 says that in a cash transaction, you are only selling goods to the customer against the cash. But whenever you sold the goods on credit terms, then there are two types of transactions hidden in this particular transaction. The first one is the sale of the goods, and you are also selling your service. And the service is the credit facility. Service is the credit facility. So in the cash transactions, only the goods are sold, but in the credit transactions, you actually sold two types of items. The first one is the goods, second one is the services. IFRS 15 says that these are two performance obligations separate. So the performance obligation of the goods will be recognized when we transfer the goods to the customer, and the performance obligation of the service will be recognized only when you provide the service. So if there is a credit transaction, first of all, you need to calculate the value of the goods and the services. So how we calculate the value of the goods? The value of the goods is the present value of future cash flows. So whatever amount that you are going to receive in present value terms will be your value of the goods, and the difference between the transaction price and the present value will be the value of the service. So whenever the question says that it includes a financing element, it means that the transaction is on the credit terms That includes the goods and the services. You need to separate the value of the goods and services and recognize the value of the goods immediately and the services over the time period. So I want all of you to just read this question so that we can start the session and start solving it. When one company made a large sale of goods on 1st July 2008, company has sold the goods, which was also the date of the delivery. So you have delivered the goods on 1st July 2008. Under the terms, so the date of the delivery is 1st July 2008. Now, under the terms of the agreement, when not receive the payment of 8 million 30th June. So you will receive the payment after 30 days. Oh, sorry, after 1 year. 30th June 2009. So you will receive the payment of 8 million after 1 year. Currently, Vendon has recorded 4 million in the revenue and trade receivables. The directors intends to record the remaining 4 million in the year ended 31/7/2009. The cost of the sale has been accounted for currently in the financial statement. Vendon has a cost of capital of 8% with the discount factor of 0.9259. So this transaction includes a financing element, which is the service value and the goods, which we have already delivered. So the 8 million includes the value of the goods and the services. So how we can calculate the value of the goods only? By calculating the present value of this 8 million. So the present value of this 8 million will be the value of the goods. So I want all of you to please use this discount rate and calculate the value of the goods. 8,000 multiplied by 0.9259. So the amount will be 7407. So if the value of the goods is 7407, so what will be the value of the service? What will be the value of the service? It will be 592. 593. Very good. So what accounting entry we can make on 1st July? What accounting entry we can make on 1st July? When we have delivered the whole goods, but we haven't received any single amount of cash. Where it is written that there is a service. It's not written in the question. It is written in the scenario. It was embedded in the scenario that this transaction is a credit transaction because we are selling the goods right now, but we will receive the payment in the future period. Very good. The accounting entry should be receivables debit. So receivables debit 7407 and sales credit with 7407. Very good. And what they have already done, they have recorded the 4 million. So they have already recorded 4 million out of this 7407. So you are required to make the adjustment of 3407. Because according to us, we have to recognize the revenue of 7407, but they have already recorded 4 million out of this 7407. So the remaining difference of 3407 will be recognized in the income statement. So it will be debited in both the receivables, added in both the receivables and the sales account. 793 is the difference between the transaction price 8,000 and 7407. Deduct 7407 from 8,000, you will get the value of 593. So, so the value of the goods is 7407 and the value of the services is 593. Now, this transaction was took place on 1st July and the year end of the company is 31st December. So the value of the whole year service is 953 and till the year end you have delivered the 6 month service. So you need to record the 6 months service revenue. So the accounting entry will be at the year end receivables debit by taking the 6 months figure 593 divided by 2, we will be 296.5 and it will be your finance income at the year end. This adjustment will be made at the year end. Yes. In a very technical terms, you can say that 593 is the timing difference that could be unwound. You're right. Receivables will be debited, not the contract asset. I hope this concept is clear. Yeah, finance income will be recorded separately. Your finance income, because you are providing the facility with the name credit facility, so the income that you derive from this credit facility will be the finance income. Finance cost, it's not the finance cost, it's the finance income. It's not the expense, it's not the finance cost. No, there is no contract asset here. Contract asset arises only when the company is providing some construction services. Why we not considered 593 is actually the service income for the whole year. And when you count the time period from 1st July to 31st December, it's actually after 6 months that you're preparing the financial statement. So that's why we have proportionated the income of 593 into 6 months. I have repeated this point several times that how you can say there is a service being provided. I was already told you that whenever we are providing credit to someone, that credit facility will be considered as a service. Just if you don't believe on me, just go and buy a car from a showroom and ask them to give you the car on the credit terms. So do they provide you the credit, the car on the credit? If the answer is no, then it means that if they are providing you car on the credit terms, then they will definitely charge some additional amount. So that's the clear difference between the transaction on cash terms and on credit terms. So whenever someone is providing you the credit of more than 1 year or approximately 1 year, then they will definitely charge some extra amount. And that amount will be considered as a income from the credit facility. Now, similar type of transaction in which company sold the goods and the services simultaneously at a single price, assuming it's 1 lakh. So what you need to do is to calculate the standalone price of the goods and a standalone price of the services in order to unbundle the price. So suppose company has sold goods and services at a price of 100,000 and goods in isolation will be sold at a value of assuming 60,000 and services will be sold at a value of 40,000. So the total value will be 1 lakh. So 60% is the value of the goods, 40% is the value of the services. So how we can separate the value of the goods and services from this 1 lakh? So 60% is the value of the goods from the standalone selling price, and 40% is the value of the service. So whenever you will be having a question in which the company is selling the goods and services in a single price, you need to separate the value of the goods and services and then record the value of the goods when the goods was delivered, and similarly the value of the service when the services was delivered. So I want all of you to attempt this question. Please do attempt this question. So let's solve this question. Shred company sells a machine and 1 year's free technical support. Machine company is selling machine and technical support for 1,20,000. So this price includes the goods and services. 1,20,000. It usually sells the machine for 1,20,000. So usually companies sold the machine separately for 1,20,000 and does not sell the technical support for this machine as a standalone product. Other support services offered by the shed company attracts a markup of 50%. It is expected to be that the technical support will cost 20,000. If the cost price of the service is 20,000 and the markup is 50%, what will be the selling price? The selling price will definitely be 30,000. So by adding these two figures, we got the value of 1,50,000. So what is the weightage? What is the weightage of machinery out of this total transaction? The weightage will be 120 divided by 150. So yes, 80% is the weightage of, I've calculated by dividing 120 divided by 150, and 20% is the weightage of the services. So out of this 1,20,000, which is the value of the goods and services, 80% is the weightage of the goods and 20% is the weightage of service. 24,000, and it will be 96,000. So how should the transaction price be allocated between the machinery and the technical support? So this is how we do the separation of the goods and services. Yeah, you can use the unitary material as well. That's not a problem. 30,000. Now see this point: the sales value, the cost price, and the profit element. The cost price is 20,000 for the service, and the sales and profit figure is not given, but it says that the markup is 50%. Whenever the question says about the markup means cost will be 100%, profit will be 50%, so sales value will be 150%. So in order to calculate the sales revenue, you need to extrapolate the value of the sales using these percentages. So 20,000 divided by 100 multiplied by 150, you got the value of 30,000. So the sales value of these goods is 30,000. So the cost price of the machine is 120, sales value is 30,000. The total amount of the standalone price of goods and service will be 150. So when we take the percentage, it will be 80-20, which will be applied on 1,20,000. The amount will be 96 and 24. Yeah, I will open the WhatsApp group. Actually, the students are not focusing here; they are focusing on the group. That's why I've blocked the chatting on the WhatsApp right now. But after today's class, uh, I will share the. I will open the WhatsApp group, as well as I will share the special plan for the guys who have failed this paper or flunked in this paper more than one time. Now, what do you think should be the accounting entry for this transaction? We have calculated 96,000 for the goods and 24,000 for the service. If you have received all the payment in advance, the accounting entry will be cash will be debited by 1,20,000. But right now, we can only record the sale of the goods, which we have earned because we have delivered the machine. So we have earned 96,000 from the sale of the machine. But we have not yet earned this 24,000 at the start of the period. So this will be recognized as a deferred income. So do remember this point: whenever the company has received the full amount in advance and not yet earned the amount, then this will be recognized as deferred income, and it will be amortized over the period in which you have earned that income. Okay, so I think the time is almost done. So what we need to do in the next class? So please be careful what all of you are required to do. First of all, you have to attempt the practice handout of day 2. related to, yeah, IFRS 15 is not yet covered. And day one, tomorrow we will be focusing on first completing the IFRS 15 area. Then we will work on financial instruments, IS 12 and IS 21, foreign currency. And if there are certain standards that was left but was important for this session, I will provide you the video lecture of that particular standard. So you can just watch my video and you will get the benefit from that video. So I'm trying to be moderate in speed. I don't want it to teach you uh, in a very high speed, at a very high speed, like blah 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 blah. So what I want you guys to deliver you the more concepts that is applicable in this session. So we do the consolidation as we have already discussed. That's our day-wise plan. Check this point. Right now we are in day 2, and tomorrow in day 3 we will cover the final accounts as well as some of the standards as I have committed. On day 4 we'll be discussing on the consolidation, and day 5 will be based on ratios. EPS is not that important. Is interpretation marks scoreable? Is it easy? Yeah, it's not that difficult. Cash flow is again not that much important, but I will share the video link for the cash flow. If someone wanted to revise the cash flow topic, I will share the video on the WhatsApp group. Please, if there are students who haven't joined the WhatsApp group up till now, please, yeah, deferred tax is important. You will cover the deferred tax in the next class. Okay. So one handout that you must have should be the practice question handout of day 1 and day 2. That's day 2 handout. So you only need to attempt the standards which we have covered, like you are required to attempt the questions from IFRS 16 and IFRS 15. Do not try to attempt IS 12 questions or any other area which we haven't attempted yet. Completed. Now, these are the final account questions in which you are required to attempt all the adjustments of the standards which we have already done. Like from this part of the question, we haven't done anything. Now from the second question, Vernon, we have attempted this part of the question, that is note number 1. Please do practice this note again before coming to the next class. And then we have attempted this part of the question already, which is related to the revaluation gain and investment property. From this question, Haverford, we haven't attempted anything. From this part, triage, yes. All of you are required to attempt this part of the question, which is bold. that is related to the non-current asset. I think we have covered this part as well in the slides. 66.3 revaluation, that's already done, and that's it. So these are the 4 questions of the final account. Tomorrow I will try to cover all these adjustments and then all of you are required to solve these questions on the Excel sheet or constructive response workspace. I would recommend you to go on the constructive response workspace. I think most of the students don't know about this. I'm just writing constructive response workspace and you will find the specimen exam, CB specimen exam. So click on the first link and go for the constructive response workspace area. So when you click on this link, there will be a window of Pearson view. It shows some initial instructions. And when you do next, next, so one of the reasons for the failure of the student is that they do practice on the notebooks, but they do not do practice on the constructive response workspace. So question number 16 is related to the spreadsheet. So now this is the area on which you need to do the practice. This is movable, this part is movable, we can move this part, and all of you are required to solve these 4 questions. Yes, the first one is the Dugan question, then we have Vernon, Haverford, and Triage. These are the 4 questions that all of you are required to solve it on this constructive response. Believe me, most of the students will who did not score well in section C are those who didn't do the practice on the constructive response workspace. So it's very important to use. You should know all the functions of this platform. It's not a complete Word or Excel format. It is actually customized Excel with limited options. So you should know how, when we use this point, when we use this, when we what is the use of this box, what is the use of this box. You should know all the tools and you should know how to prepare the P&L balance sheet on these formats. That's very important. So the assignment is to do the practice from day 2 and day 1 MCQs, and the question which I have marked, like again I'm repeating, when on note number 2, note number 1, and note number 4 and 5. Haverford note number 4 and Triage note number 2. So these are the assignments for the next class, and the answers of the day 1 was already shared on the WhatsApp group. You can check the WhatsApp group. I have shared all the answers. For the March 21, if you wanted to know about the important areas, I would recommend you to just follow my guidelines. And for the resitters, I will share the specific plan on the WhatsApp tonight. So wait for there's just 4 questions needed for the repeated adjustments. Could you please open the WhatsApp group discussion? Thank you. Yeah, so thank you so much for today's session, and we will discuss the relevant accounting standards. It was left tomorrow, and please do attempt all these 4 questions and MCQs from day practice day 1 and 2. If you wanted to do further practice, you can open the Kaplan kit, and do practice of all the standards that we have already covered. Please give your valuable feedback to the ACCA, because ACCA wanted to know that how you people are feeling after taking these uh, valuable practice pass sessions. So again, if it is helpful, please give your valuable feedback to the ACCA. Thank you so much. Do take care of yourself. We will meet tomorrow. Take care. Allah Hafiz.